if you use your own money, you can invest in the stock market without any issues. So, one of the main problems that I see for people who want to invest in the stock market is that they have something holding them back. Sometimes it is that they are scared their money will be lost. Maybe some people have issues in ways that they think what they are investing is not ethical, or maybe they have certain religious issues that they might have. So in many cases there are solutions to almost everything in the world. If you think there are certain restrictions in terms of your religion or in terms of your ethical or moral compass, then even then there are certain options that you can choose from which would be ethical, religiously acceptable. The first thing that we are going to discuss here is the different investing options. So you can invest in the stock market, you can buy gold, real estate, cryptocurrencies, commodities, bonds. There are many options available, but for the sake of simplicity, today we're just going to talk about investing in the stock market. So, before you even begin to invest your first cent in the stock market or anywhere else, to be frank, you need to think about mainly three things. The first thing is the emergency fund. The second thing is the time horizon, and the third one is risk tolerance. If you skip one or more of these things, it can cause trouble, because these are one of the few things that are essential to your success. I'll explain why in detail. So, the first thing is, and that is an emergency fund. So, an emergency fund is a stash of money that you set aside to cover the financial surprises life throws your way. For many people, the definition for an emergency fund could be different, but for most people, it is something that you save for, as the name says, an emergency. People ask me how much amount or how much money should they keep in an emergency fund. As a general rule, people should keep 3 to 6 months of their expenses. So for students, let's say it's difficult to keep a 6 months expense as an emergency fund, but at least 1,000 euro should be kept as an emergency fund for students. If you don't have 1,000 euros, never even think about investing in the stock market, crypto, or whatever. So please be careful. Have an emergency fund. In my opinion, 1,000 euros is the least amount that you should be having in your emergency fund. For employed individuals, 3 to 4,000 euros could be sufficient. For married people with children, at least 8 to 9,000 euros should be kept in a separate bank account. Now, here you have multiple options. You could put that money in a savings account, or you could put it in a separate zero konto or a current account. It depends on how you want to keep that money. But in an ideal case, it should not be invested. Next, we have the time horizon. Most people, when they start investing, they don't have a clear idea of how long do they want to stay invested in the stock market. Do they want to stay invested for the next 12 months? Is it the next 5 years, or is it more than the next 10 years? It's essential, because if you do not understand the meaning of this investing time horizon, it can lead you to different conclusions. For example, let's say if someone starts investing today and they haven't even thought about their investment time horizon, every time there is a huge market fluctuation, they would be in a confused state. For example, let's say if the stock market, what we have been seeing in the past 3 or 4 months, the trend has been going downwards. And if you had a concrete plan, for example, let's say for the next 12 months, it would have not been recommended for you to invest a lot of money in the stock market either way, because 12 months is a very short term. 30 months, so it can be in between short and mid-term investment, but still you have an idea. You want to keep your money invested in the next 5 years. Maybe your next goal could be to buy a house with that money. Your next goal could be to keep your money away from inflation and on the side have the upside of a stock market. If the values go up, you could have a great upside. And for 10 years plus, for people who think that they would buy a house in the next 10 years, or if buying a house is not their cup of tea, they can still use the advantage of investing in the stock market. So it's an ideal thing to think about the investment time horizon. For example, when I started investing, my thought process was I'll just wing it and I'll think about when I want to sell or whatever. So the first few days or within the first few months, there was a huge fluctuation, and that fluctuation really caused a lot of stress in me, and I did very bad decisions in terms of investment. I sold a lot of things which I should not have sold at that time, and I even bought back the same investments within a day at a loss. I've discussed this in multiple of my videos, so I won't go into the details for that. But still, you have to be careful and understand the time horizon and see how long you want to invest. Obviously, you can change your time horizon, but still, you should at least think about how long you want to stay in the market. The third very important factor that you need to look into is the risk tolerance. And that is how much loss, realized or unrealized, I'll discuss that in a moment, can you resist? So, for example, if the stock market is going down and your investment has gone down 1%, can you sleep over it? For some, it's okay. For many, it's still okay. But for very few people, 1% is a very huge loss for them. Is 5% okay? Is 10%? Is more than 10% okay for you? You need to realize this even before you start investing. Now, let me discuss realized and unrealized. When you make an investment in the stock market, you buy stocks, ETFs, or whatever, and you see the graph going down and the market has lost its value, but you haven't sold that stock or if you haven't sold that ETF, this means that it is an unrealized loss. And only if you sell that stock or ETF will you realize that loss. So let's say if a company or an ETF lost its value 2%, right? So on paper, you have lost 2% of its value. But let's say, and hopefully, if it recovers, it goes up, and you hadn't sold that stock or ETF, now it is in plus. So it is an unrealized profit. And if you had sold it at a loss, it would have been realized loss. Or if you sell a stock or ETF at a profit, that would be realized profit. With realized losses and realized profits, there are certain things you can do in terms of taxes. I'll discuss that later on in this. Okay, now you have thought about the time horizon, you have an emergency fund, and you have also assessed your risk assessment, right? We have a lot of options when it comes to investing in the stock market. So you have stocks, individual stocks, then you have bonds. After that, you have funds. Funds includes exchange traded funds, mutual funds, and index funds. You also have commodities. So when it comes to single stocks, huge companies, small companies, a few examples could be Microsoft, Tesla, Amazon, etc. You can invest in those companies individually, right? So let's say you want to invest in the Microsoft stock. The one of the biggest issues with individual stocks is the fluctuation, right? So if you invest in a single stock, you have a decent chance of riding the upside, but also the risk is great in terms of loss as well. Now, the market has been going very well since the past 5 years. So you can see that the Microsoft stock has risen how much? 140% in the last 5 years. But let's zoom in a little bit and think about the performance since January. So the stock market has performed very bad since the last 2 or 3 months. And if you had started investing in individual stocks, you, let's say in our example, Microsoft, you would have lost 25% within these 4 months from 23rd of January to 22nd of April. So with individual stocks, there is a huge upside. However, there is a huge risk as well. Let me share one of the crown jewel of German economy. So this is Wirecard. This stock was a very good financial stock. It was performing very well. It had steady growth. And then at a certain point, there was huge financial fraud. So on in May 2020, almost 5 years ago, there was a news that there were billions of euros missing from this Wirecard company. So within days, the value of that stock went from $92 all the way to 1 and 0 point something. And at the end, after a couple of months, this company went bankrupt. So when we think about individual stocks, there is a huge upside, as I said, but there is a huge risk as well. A company can go to zero and you can lose all of your money which you have invested in it. So for many beginners, it is not recommended to look into individual stocks. As a beginner, it's ideal to look into exchange traded funds. So, exchange traded funds or ETFs have different kinds. There are index funds, there are specific sector funds. For example, there is an ETF which only invests in semiconductor companies. There is an ETF which invests only in companies that are Sharia compliant. There are ETFs that only invest in technology sector or a specific sector or multiple things, multiple themes, multiple topics. So the huge benefit to investing in ETFs is the diversification. So if let's say you invest in an ETF that is covering 10 companies, right? So you have diversified your risk in 10 different companies. If you invest in an ETF which invests in, let's say, 1,000 companies, you have diversified your risk into 1,000 different companies. So let's say in an ETF which covers 10 companies, one company goes bankrupt. Only a certain portion which is invested in that company goes to total loss, right? And the 9 companies which are not bankrupt will still survive, and your money, at least not your whole money, has been lost. So the more companies, the more diversification you have, and the less risk you have in your portfolio. But the opposite is true as well. So the more diversification you have, the growth is relatively low compared to individual stocks or companies which have lesser number of companies, because the risk is distributed. Let's say again, going back to the 10 companies example, there are companies who would be performing very well, some companies would be performing bad, and some companies would not be performing good or bad at all. They would be just performing average, right? So you have an average of those companies. If it's 100 companies, the average is different, and if it's 1,000 companies, the average is again totally different. So you have to play a balance game and look into stocks or ETFs that you are aware of. And as I said, for beginners, it's always recommended to look into diversified index funds or exchange traded funds. So now you know what you need to do before you start investing, what you need to consider. Is it stocks or ETFs? But how can you practically do your investments? How can you start investing? So in Germany, or firstly in the whole world, you have a securities account which you use to buy securities. Let's keep things simple. A securities account is something that holds your stocks and ETFs. Now, in Germany, it's called a depot konto, and there are different kinds of options available. There are different kinds of providers that help you open a depot konto or a broker account. The general or the older model is you go to a bank and you ask them to open a securities account for you. In most cases, every bank has a securities account option. Very few banks don't have this. For example, Deutsche Bank has it, Sparkasse has it, Postbank, almost every huge or small bank has this option. But for many people, it is easier and quicker, and in many cases, cost efficient if you look into neo brokers. Now, neo brokers are specialized companies who, in most cases, are usually only involved in securities or stocks and ETFs. Two of the biggest names that we have in Germany are Scalable Capital and Trade Republic. Now, both of these companies are very well known, quite safe, and very popular among the expat or English speaking community in Germany, as well as in non English speaking, the native Germans as well. So, I've used both of these platforms. I'm very satisfied with both of them. But from my own personal experience, Trade Republic has an issue that it does not accept many nationalities. It might be a problem for you to get an account with them. So, in terms of acceptability for international expats in Germany, Scalable Capital, at least in my opinion, or from the people that have used it and their feedback, Scalable Capital has a higher acceptance rate when it comes to getting securities account with them. But from my own personal experience, I see little to no difference in both of them. So if you have an account with one of them, it's great. If you want to start and you're allowed to open, both of them are very good options. So you can start with them. So let's talk about taxes. Anytime you realize a profit or a loss, taxes are involved. Now, as I said, if you sell a stock, if you sell a ETF, and there is a profit involved, which means you have realized your profit. Each year, as an individual, you have €1,000 tax free limit. This means that this 1000 euros is totally without any taxes if you have realized your profit. Now, let's say if you do not realize your profit and the year goes by and you have no profits, this tax free limit does not accumulate. So, if you haven't sold any stocks or ETFs at a profit, you will not get this 1000 euros back. The next year, you'll have 1000 euros for that year. So, this is one thing that you need to be careful about and know that it is not stackable. The next thing is, let's say if your tax free limit goes above 1000 euros. So after the 1000 euros, you would be paying 25% plus the solidarity on top of that. So it's approximately going to be 26.75% on the profit. So this means that, let's say if you invested 1000 euros in Apple stock and this 1000 euros increased to 2000 euros and you sold 1000, right? So from this 1000 euros, you would be paying 25% plus solid. So it is approximately going to be 265 euros point 5 cents in taxes. If you have already used this 1000 euros. So if you haven't used your 1000 euros tax free allowance, then this 1000 euros profit would still be tax free. So if you have more than 1000 euros, then you would be paying 26.75 approximately percent in terms of taxes. So there is an ETF tax which most people generally do not know, and it's called the 4-up pauschale. So the 4-up pauschale is an advanced tax on potential profits from accumulating ETFs. I'll discuss accumulating and distributing in a second. But even if you haven't sold anything, you have to pay a small ETF tax. So accumulating ETFs are those ETFs which do not give out dividends. There are certain ETFs which give out dividends. Those are called distributing ETFs. So whenever an ETF distributes dividends, the government cuts a certain amount of tax, which is again 25% plus 5.5% of solidarity. And if your investment is not huge, you can obviously get this tax cut from your investment portfolio and it goes automatically from your 1000 euro tax limit. Going back to this 1000 limit, this is per person. If I hadn't mentioned it already, if you're married and your spouse is not investing, you can utilize that 1000 euros as well. So for a couple or for a married couple, there is 2000 euros per year tax free limit. So this 4-up pauschale is cut from the government to avoid tax free growth forever. And the government assumes a fictional profit rate and cuts a tax from your unsold ETFs every year. So each year, a small amount is calculated. This amount is calculated at the start of the year, which is based on a base interest rate. So this base interest rate for the year 2025 was about 2.2% approximately. And you only pay taxes on the ETF gains. And those gains, if they exceed above the 1000 euro tax free limit, only then will the tax be cut from your account. So in many cases, I don't have the exact numbers, but for you to get a tax cut from your ETF, your portfolio in ETFs would have to be more than 100,000 euros for it to go above your 1000 euros tax free limit. So for almost every single beginner, this 4-up pauschale doesn't play a huge role. Obviously, there are certain calculations. I won't include those calculations, but as I said, it plays very little role for almost all beginners. And unless you have a huge portfolio, only then will you be paying taxes outside the tax free limit. So there's a question, if I don't sell anything, let's say for the 5 years, will I get 5K tax reduction when I sell it after? No. As I said, this 1000 euros tax free limit is for each year and it is not stackable. So if you do not use it that year, you will not get any benefit the next year. So in your case, if you have invested for 5 years and you sell at the end of 5 years, only that year's tax-free profit would be considered. Other than that, the 4 years, if let's say there wasn't any 4-up pauschale or any other dividend tax, then this 1000 euros tax-free limit would be lost. So you need to look into that every year. So how can you start? So first thing is you pick a broker. As I said, you have many options. You can go for a traditional bank like Deutsche Bank, Sparkasse, Postbank, or you can go for neo brokers like Scalable Capital, Trade Republic, Trading 212. There are many options. But one thing you need to consider is if you are using a German broker, all of these things, the Vorabpauschale, the tax-free allowance, the capital gains tax, everything is done automatically by the trading app. So in many examples, let's say Trade Republic and Scalable Capital, they automatically cut all of those taxes for you if you have set it up properly. To set it up properly, you need to provide your tax class, which is automatically attached to your personal identification number. And then you provide the personal identification number or again the tax number into your app. And then all of your taxes in terms of Scalable Capital or Trade Republic would be connected to the finance arm. And then if you get a profit, your app automatically informs the finance arm and your tax-free allowance is cut and the information is automatically transmitted. But if you do not set up your app properly, your taxes would be sent to the finance arm, but your tax-free allowance would not be set up properly. So you would be paying more taxes. But at the end of the day, if you haven't set up your Freistellungsauftrag or the tax-free allowance, then you can always get it back if you submit a tax return. So as I said, once you pick a broker, next you have to add funds. Now, once you add funds, you have different options. You can directly buy a stock or ETF, or you can use a savings plan. I'll show you a savings plan just shortly so we can have a practical example as well. The third thing that you need to do is start with ETFs. You can start with individual stocks, obviously, but as I said, for beginners, it's very time consuming. It's not recommended at all to start with individual stocks. So if you're a beginner, you start with ETFs, spend some time, learn how the stock market reacts, how the stock market works. Then you can look into individual stocks because now you have some experience. Now you know how the stock market reacts to different news. And you, as I said, would have some experience by now. And then you would be more comfortable in investing in individual stocks. And the best thing is if you set up a savings plan and if you invest in ETFs or even stocks, you can do it passively. But for stocks, you would have to look into many things for you to do it passively. As I said, let me share my scalable capital portfolio and show you the different options. For example, a savings plan, what does it mean? And certain things that you can look into. This is my scalable capital portfolio. I'm also using the free broker. I use savings plans, so I don't need to look into the premium options that Scalable Capital offers. So at the end of the day, it's totally free for me. And you can also do the free account. In most cases, no need to start with the paid account. So here you can see the total portfolio value, how the portfolio has been performing in the 1 day, 1 week, 1 month, 1 year. And since I have started this portfolio, so let's go into the details a little bit. You can see here I started this portfolio in round about 2021, and the portfolio went up to, let's say, a maximum profit of unrealized profit of 13,000 euros by the December 2022. But then it went from around 13,000 euros unrealized profit all the way down to 3,900 euros, which means that within a few months, there was a huge loss of around, let's say, 9,300 euros, which was again unrealized. I did not sell anything. And then within the last few days, there has been an unrealized profit of 4,000 euros. So there are many things to look into, but as you can see here, the stock market performs very differently depending on the different kinds of news. There are ups and downs, and for many beginners, it can be very overwhelming. So let me just go back to the overview and share what I'm investing in right now. I'm investing in the S&P 500 information technology sector. Then I'm investing in certain single stocks. Obviously, I know I have said that it's not recommended, but I have some experience now in the stock markets. I'm obviously looking into individual stocks as well. So I have Microsoft, IBM, ExxonMobil, 3M Co, Ventum, ASML, Schneider, Sanofi, and Merck. As you can see here, certain things are in profit, certain things are in loss. Overall, as I said, my portfolio is in about 8,666 euros in profit. I'm also investing in cryptocurrencies, or to be correct, I was also investing in cryptocurrencies using scalable capital. Now, scalable capital does offer cryptocurrencies, but they do so in terms of ETPs. So these are exchange traded products, which are similar to how ETFs work. These are not pure cryptocurrencies. These are similar to stocks or ETFs, which are traded in the stock market. So this means that the profit or loss would be similar to stocks. There is one thing that cryptocurrencies are taxed differently. If you hold a cryptocurrency for more than a year, any profit is tax free. And if there is a loss, again, you cannot adjust those losses against anything else. You can only adjust those losses against profit from cryptocurrencies. But as I said, this video is not concerned with cryptocurrencies, so I won't go into the detail of cryptocurrencies here. Okay, let me just cover savings plans. A savings plan is nothing but an automated process. Let's say you want to buy ASML Holdings, which is a single stock, but you can start from a single euro up to a maximum of 5,000 euros. You can select a frequency of monthly, every 2 months, quarterly, 6 months, annually. So this means that if you are having just 1 euro, you can invest 1 euro one every month automatically. You can also select the execution date. For example, let's say you can select from the 1st, 4th, 7th. You have 9 different options, and you can select this month, next month, and the month after that. And you can set up a payment option. You can either add funds to your account manually, or you can ask the app to cut those funds automatically from your bank account. So essentially, what this does is automates your investing. You don't have to do anything. For example, in my scalable capital portfolio, I have 500 euros investment every single month. This is done automatically. I do not do anything. I just set it up and then I forget about it. Now, there's one thing that a lot of people do get confused with is this similar to a savings account or whatever? No, this is not similar to a savings account. You can change, for example, as you can see here, I can change this value from 50 to 500 euros. I can change the frequency. I can change the execution date, or I can even delete this savings plan. So it's not a hard and fast savings thing that is not equivalent to a savings account, which has less flexibility in terms of a fixed term or a modified term. This is something that a lot of beginners can take advantage of. Look into a company, look into an ETF, set up a savings plan, and let it run automatically in the background. So I have set up a single ETF, then a couple of stocks which have 50 euros running as a savings plan every month. And as I said, I have 500 euros of savings plans running automatically in the background, and I don't usually do anything. Sometimes I do look into individual stocks. I have changed my strategies, but again, it's a more complex topic which I won't be covering. So is there any difference between the standard S&P 500 and the one that I have? Yes, it has a difference. The one that I have is the information technology sector of the S&P 500. So the S&P 500, as its name suggests, is an index that tracks 500 of the biggest companies in the United States. So if you invest in an ETF which is tracking the S&P 500, you would be investing in those 500 companies. But this is the information technology sector ETF of the S&P 500. This tracks the information technology companies within the S&P 500. So here is a document which details what this ETF does. But for simplicity's sake, as I said, it tracks around 35 of the biggest information technology sector companies within the S&P 500. Now, also, if you look into the ETF section, you can see here that I have searched for the S&P 500, right? So you can see there are a lot of options available here. Once you select an ETF, you simply have to look in the details as well. The first one is the S&P 500 technology sector ETF, and then in the ACC. AC means accumulating ETF, which means they do not give out dividends. Any dividends that is given by the companies is reinvested within the ETF. The next option is the iShares S&P 500 accumulating. So this is an ETF which is investing in the 500 companies. The next option is DIST. This is distributing. In terms of price, you can see that this is 565 euros and this is 52 euros. Even though both of them are S&P 500 and both of them are tracking the whole ETF or the whole index. The difference in price is because they are having a different weightage in terms of tracking. So going to the next ETFs, you can see here, this is just the energy sector. This is having an equal weighted accumulating. This is a hedged one. This is the top 20. There are, as I said, there are many different things. You can also look into the first name or first word that's written. So here it is iShares. iShares is a provider. SPDR is also a provider. There are other providers like iTrackers, Global X, USB, no, UBS, sorry, different providers which provide similar kinds of things. However, there are certain changes. Again, those are more technical in terms, but let me share a few things with you guys. The difference could be in terms of total expense ratio. Now, this is the fee that is paid to this company, iShares. So each time you invest or every year for this ETF, you will be paying 0.07% per annum to this company. If you buy an ETF or if you buy a mutual fund through a company, that company usually takes 5 to 10%. If you go through an in-person broker, they also have a percentage based 1, 2, or 3% per year. If you're looking into an ETF which has a total expense ratio of more than a 0.5%, it's on the expensive side. So anything below 0.5% is okay. Anything that is below 0.1% is among the good ones. So you can usually find something that is tracking an index around 0.07. There is also something that is available on scalable capital for 0.04%. There are also other things to look into. For example, the distributing policy. As I said, this is accumulating. Then there's the replication process, then the domicile, many other things. But as I said, those are outside the scope of this video. Let's have a look at this example, right? What we want to do is we want to buy at regular intervals and we want to keep buying. Let's say if you have set up a monthly savings plan. So you're buying at the high points in a relative small time frame, but you're also buying at a lower point as well. So at the end, we are having a net average effect, which is called the dollar cost averaging effect. We are buying at, as I said, high points, low points, and in the long term, we are generally above the average. So let me go back and share my portfolio in terms of the ETF. As you can see here, I have bought an ETF worth different amount every single month. Sometimes at, let's say, 30 euros, sometimes at 31. I've also bought it at 25 euros because it is done automatically. I'm not looking into the individual dates or months. And as you can see here, I have invested 7,800 euros into it and I have an unrealized profit of 1,400 euros. So my total buying is at 25.39 euros. As you can see here, the value for this ETF is 29.995 euros and my average buying price is 25.39. That's why I have an unrealized gain of 18.12%. Buying date is generally not that much if you're looking at the big picture. Now, if you know something more specifically, if you have some sort of information that many people don't have, only then you can look into a specific date. Otherwise, it makes little to no difference in the long term. Can you withdraw unrealized profit? So, as the name suggests, it is unrealized profit. You can only first realize the profit. To realize that, you have to sell a small portion of your investment and then realize it and then sell it and then transfer your or withdraw your profit from your scalable capital or whichever account to your bank account. For example, let's say I have an unrealized return of 18% or 1,000 something euros. I have a total of 309 shares. So if I decide to sell, let's say 100 shares, I would be realizing the profit. In terms of 100 shares, I would be having 100 and whatever profit that I have. And then I would be paying taxes if I have already crossed my tax-free allowance or Freistellungsauftrag. And if I haven't done any sales, then this profit below the 1,000 euros would be tax-free. Going back to your question, you have to realize the profit and only then would you be able to transfer your funds into your bank account. if I decide to leave Germany, can I carry on investing on scalable capital? Yes and no. You can carry on investing in scalable capital only if scalable capital is available in that country. If scalable capital is not there, you cannot use this platform. But there are other options. So let's first cover scalable capital itself. It is available in many European countries. If you change your countries and scalable capital is available in that country, you can contact scalable capital and let them know that you're changing countries, but scalable capital is available there so they can update your tax information. If scalable capital is not available in that country, what you can do is first identify which country you're going into and then identify if there is a broker available in the next country or your goal country and in Germany as well. For many countries, one of the biggest brokers in the world, it's called Interactive Brokers. You can look into Interactive Brokers, which is available in Germany and most likely in the country or your destination country. You can open a Interactive Broker account here in Germany, transfer your scalable capital ETFs or whatever portfolio from scalable capital into Interactive Broker, and then let Interactive Broker know that you will be moving to X country. And obviously, if Interactive Broker is present in that X country, you can ask them to transfer your broker or depot konto from Germany to that next country. So this can be something that you can do. Should we follow any recommended investment groups? I am not a big fan of investment groups. Some groups are paid, some groups have a huge number of scammers. And even if the group is totally scam free, if you are like open to paying, obviously not bad to pay for something, but even if it's not an unpaid or whatever scam free project or a group, even then you need to know certain things about investing in order to utilize that information. Now, if you are a beginner and you don't have any knowledge on like signals or whatever, how a stock has been performing, if you haven't done any technical analysis and someone says, okay, buy this X company, it's going to go based on their own technical analysis to, let's say, 2x, 3x, or 5x, or whatever, and then you buy that company and it doesn't perform well. They are not accountable for that recommendation. So it's at the end of the day, you need to be having enough knowledge to follow that signal. It's a difficult question to answer, but as a beginner, I do not recommend you to follow any investment groups, at least until you have a certain amount of months or years experience and you know how the stock market is performing, how different things in the stock market work. And if you are looking into Sharia compliant stocks or ETFs, you can search for Islamic. You have these three options available if you are looking into Sharia compliant ETFs. So you have the emerging markets Islamic distributing ETF, you have the USA Islamic distributing, and then you have the MSCI World Islamic distributing. You can look into these three. And as I said, if you're not, you can also look at the non Sharia compliant, the MSCI emerging markets, the MSCI core S&P 500 ETF, and the MSCI World regular or Islamic if you're looking into Sharia compliant ETF. In most cases, German brokers are having the stocks or ETFs which are having European domicile and most likely the Irish domicile. You don't have that many tax implications. So if you're looking into an ETF, go into the core data, look at the fund domicile. If it's European, most likely it's going to be Ireland. It's not going to have that many implications in terms of the taxes. And obviously, these are denoted in euros, so you don't have to worry about that. That's why it's for many people, it is better that they look into brokers that are within Germany. And if it's not possible, then look into European brokers. So that way you don't have to worry about, as I said, taxes and domicile, stuff like that. And as I say to everyone who is still struggling to get started, please look into different sources, check, recheck all of the information. Don't blindly believe people. You don't, even for myself, whatever I say, please look into things, check and recheck things. Sometimes things can be outdated, sometimes things can change when you're looking into something. So please do a lot of research. It's your hard earned money, but start today so that this money works for you and you don't lose that at least against inflation. So thank you again, and I'll see you in one of my videos.